one of the things that while the broader markets are certainly getting most of the attention, and again, I do expect a little bit more window dressing rally to commence, and I don't want anybody thinking that, the window undressing sell-off or dumping these positions that are put on at these highs into the year end is suddenly on the first trading day of the new year are going to be dumped. I don't want anyone under that illusion, but as far as things that I feel a little bit more comfortable shorting at the moment, and I do want to be a short seller in equities eventually, I'm not ready to short stocks yet, but I am looking at shorts in the euro. So let's talk about this area around 112 in the euro US, and then we'll translate that over to the futures, the euro FX futures, as well as the FXE ETF. And then you could do puts on either one of those as well. So notice how many times we've traded up into this zone, a number of times. And I don't feel that this move is indicative of suddenly a hawkish ECB or suddenly some sort of dovish U.S. central bank, FOMC. I don't think any of that. That would be a different conversation. I don't think we're seeing any significant central bank shift. All right. I think that we can see unwinding in the U.S. dollar longs. We can see unwinding in pound longs result in a little bit of euro, U.S. dollar strength, or euro strength, really. But I think that puts us right back at a level here that is absolutely shortable. Now, the uncertainty is what? The uncertainty is what if we keep going past 112? All right. So here's what we would think. The FXE ETF and the 6E Euro FX futures both have options. There aren't any options on the foreign exchange. Okay, so currency trading does not mean it has to be foreign exchange, but I still think you want to look at the main marketplace for currencies, and then you can look at alternatives, futures and ETFs being amongst them. So now we start looking at the FXE puts. Now give yourself time. This is going to go back to that 45 to 60 day window. So really you don't want to be looking at anything closer than, quite frankly, the January 7 or January 21 options chain. And quite frankly, both of them are very illiquid. So you're going to end up very likely out in the March 20 FXE puts, because when you start looking at the open interest, that's where it seems we have quite a bit of open interest. So you'd end up way out in March. Now, is that a problem? No, because nobody needs to be tangling with the theta decay monster when they're looking at directional trades. I don't need all that time to March 20th, which is 84 days, but it sure is good to know that I have the time. And these are not prohibitively cost options. In other words, if you want to buy a 106 put, it's going to run you 81 to 88 cents per put for the 106 strike for March 20. Now, if you want to go take a look at the 6E, again, you can look at the underlying options rather than shorting the Euro US or even shorting the futures. Okay, so with the 6E, you're going to likely go out in time. Now, March would be the next date that I think one has plenty of open interest. February does too. So with the 6E, you've got a few choices. You could go with the Feb 20 puts around the 112.50. You can also go with the March 2020. Okay, so Feb 2020 or March 2020, 112.50 puts. Both those are liquid options chains. Okay, so yeah, I like the short. I think positioning yourself with the options on either the FXE or the 6E is fine. And sure, playing the straight up Euro US is fine too, but a lot of leverage here. And so the closer you are to 112 even, the more you can minimize your risk. Okay, the more you can minimize your risk in terms of the 112 handle sort of being the level at which you're thinking, yeah, if we get above that, I probably want to get out of the short. Okay, all right, hope that helps.